guys, welcome back after the break. We were doing the examination related question, the past examination question. The next question we'll take up is Vernon Co. This was also asked in 2017, some attempt. Well, let's read through that question. Following is the extract of trial balance of Vernon Co. as on 31st December 20x8. Maybe year is ending on 31st December. Maybe this company is following calendar year, Jan to December year as its financial year. Cost of sales they've given, finance cost, investment income, operating expense, revenue tax. If you just check, all these are P&L informations. Yes, so probably they're asking you to prepare SPL again, I think. Okay. So they've given notes for everything. Let's see. They must have probably not done them properly. We need to revise a few things maybe. Okay, Vernon has made a large sale of goods on 1st July 20x8. Okay. Which was also the date of delivery. So goods have been sold, goods have been delivered. So looks like performance obligation has been satisfied on the same date. That means they should have recognized the revenue, yes. However, Vernon will receive a payment of 8 million on 30th June 20x9. Check guys, what is the date of sale and the date of delivery? 1st July 20x8. When are you receiving the money? On 30th June 20x9. That means you're selling the goods and you're receiving the money after 1 year, can I say? From the date of delivery till the date of payment. There is 1 year gap. Yes. Fine. Can I say so? That means which concept of IFRS 15? They're targeting IFRS 15 ka one concept they're testing. Okay. Which we used to call it as SFC for our class purpose. Anybody able to identify what is that? Which concept are we targeting here of IFRS 15? If there is a time gap between the date of delivery and the date of payment, there's one concept known as significant finance component. You remember SFC we used to study, alright? The SFC generally comes when you have received the money in advance or there is a deferred consideration, meaning consideration you're receiving later. So this 8 million what you're receiving, is it the current value? Is it 1st July ka value? You have made the sales on 1st July. Is that 8 million 1st July ka value or is it value after 1 year? It's a value after 1 year, meaning it's a future value. Hence, what do we need to do? Whenever there is SFC, revenue should be recognized at cash price equivalent, we say. Meaning revenue should be recognized at the present value of the cash flow. So they must have given discount factor. Okay, let's read through this. Vernon has recorded 4 million in revenue. What did they do is 50% of the revenue they recognized. And trade receivable. They passed the journal entry, trade receivable account debit to sales for 4 million. Goods ka worth is 8 million. 50% they booked the revenue. Directors intend to record the remaining 4 million for the year ended 31st December. They are saying, I will book the remaining revenue next year, 31st December it seems. Okay, not in the current year. Next year ended May, I will book is what they are saying. The cost of the sale has been accounted correctly because you have sold the goods, no? So you have removed it from inventory is what they are saying. Okay, you have valued the inventory by doing a physical check. Hence, inventory is proper. There is no mistake. Vernon has a cost of capital of 8%. Why do we require this? Because 8 million is the future value. We need to find out its present value. That present value only we call it as cash price equivalent. So revenue should be recognized at that value. Let us say cash price equivalent comes to 5 million assumption. Let's say it comes to 5 million. Then they have recognized 4 million only. That means some extra revenue needs to be booked like that. That is the indication. Okay. This we had learned. If you remember in the chart, and I'll just show you the charts to retrace your memory if you want. SFC, significant finance component. Okay, SFC generally exists in case of deferred consideration or advance receivable transaction. Okay, this SFC could benefit the entity or it could benefit the customer. Doesn't matter who it's benefiting. All right, but however, revenue should be recognized at cash selling price or cash price equivalent. We say, and how do you get cash price equivalent? The present value of cash flow is nothing but cash price equivalent or cash selling price. We say, okay, the total proceeds minus cash selling price is nothing but time value money ka interest charges. Okay, interest, finance charges or finance income here. This is a finance charges or finance income. Okay, the difference between the time value of money. Right? It's a finance income. Fair enough. Though I've written chart in the finance cost, it's basically finance cost as an income you should recognize it because this we are receiving, correct? So it's a finance income, we should book it here. Manageable as an investment income you need to recognize. Comfortable, that concept they were testing here. Okay. Alright, again, if you want to buy these charts by any chance, you can go to learn.ArivuPro.com. There you will be able to see ACCA. Under that, you will be able to purchase our classes or our chart book as such or our class books. Any which way you wanted, you can just go for it. Okay. Alright, coming back to the question. So this adjustment, more or less, I think you're comfortable. Yes. So like we'll read through everything and then we'll do the adjustments one by one. First adjustment is pretty straightforward. So we need to calculate that, and I think it has some revenue adjustment is required. Also some investment income will be there here. Okay, because time value money ka interest component will come. Okay, that is one. Vernon Co. also sold goods to an overseas customer on 31st December. Okay, 31st December 20x8. That is just 1 month before the current year ended. Current year is ending on 31st December. So in that last month, we have sold the goods to overseas customer. The moment they say overseas customer, what do you think they are targeting here? India is 21 ka. Okay, we have some foreign currency transaction. From foreign currency, we have to record it to local currency. Yes. If you retrace your memory, all the transaction, whether monetary item or non-monetary item, initially will be recorded at transaction date ka spot rate. Settlement will happen at settlement date ka spot rate. In between transaction and settlement, if your year is closing, if you have any balance, then monetary item should be restated in your balance sheet using the closing rate. And if there is any gain or loss, that should be transferred to SPL. We have done about 3 questions based on this 3 or 4 questions. And we have it in our charts also. I don't know whether you are remembering it or not, but still everything is called out here. Yes, this is a charts relating to your India is 21 foreign currency transaction. This concept they have just brought in here as such. Okay. All right. So let me come back. So they have sold the goods here for 12 million chromets. So that particular country you have sold, its currency is chromets, KR. The sale value is 12 million chromets. This is a 60 days payment term. Okay, 2 months credit, fine. No entries have been made to record the sale. So journal entry they have not passed. Sales only they have not recorded means whatever sales revenue they have given in the question, this 75, 350, is it correct or incorrect? They have not recorded the sale. That means the value they have shown is incorrect. So we need to find out the revised or correct amount of the revenue. Alright. Although goods were correctly removed from inventory. Since you have sold the goods, they have removed from inventory valuation. How? Inventory can be also valued using the physical count method. Physically you counted the inventory. You did not find them because it was sold. Hence that way you valued the inventory properly. But only sales you did not record it properly. Okay. So inventory and cost of sale is correct is what they are saying. The amount remains unpaid till 31st December. Obviously you sold the goods on 1st December. No. So credit period is 2 months. That means the customer will only pay in 31st January. That comes in the next year. That means you sold the goods on 31st December. That 1st December ka initially every foreign currency transaction will be recorded at transaction date ka spot rate. This transaction happened on 1st December. That we call it as transaction date ka spot rate. Have they given the exchange rate on? Because this is in chromets and this company is all presenting its value in dollars. Check. On 1st December, $1 is equal to 6.4 chromets. That's a presentation. We have done this sort of presentation problem also, right? $1 is equal to 6.4 chromets. That means 12 million chromets is equal to how many dollars? We need to restate. So 12 million divided by 6.4 if you do, you're going to get that many dollars. That will be the dollar value you'll recognize. Meaning you'll pass the journal entry. Receivables account debit to sales, that much. Okay. However, since receivable is a monetary item or a non-monetary item? Receivable, MI or NMI? MI as in monetary item, NMI as in non-monetary item. Receivable, MI or NMI? MI. How? Monetary item are those items which can be expressed in fixed denominations of currency is the actual definition. For layman terms, for our understanding, what would we say? If the value is fixed, it is monetary item. If the value is fluctuating, then it is a non-monetary item. You sold the goods here for 12 million kryptons or chromets. That means how much will debtors give you? 12 million chromets. Yes or no? That means value is fixed. So debtor or receivable is an example of monetary item. And as per IAS 21, all monetary items should be shown in the balance sheet using the closing rate here. Okay. So but initially you would have recorded a transaction spot rate. No. So between this transaction spot rate and closing rate, there could be some difference. That we call it as exchange gain or loss. That should be transferred off to SPL. Okay. That we will see. Under SPL, you will show it under operating expense as a deduction. Okay. So here on 31st December, meaning 31st December, books is closing. The day you close the books, that we call it as closing rate. Here books is getting closed on 31st December. So that is $1 is equal to 6 chromets. So you need to restate your debtors if there is any gain or if there is any loss. Could be anything. And gain loss goes off to SPL. A simple adjustment. We have done it. We'll again redo it in this problem also. Vernon Co. acquired 9 million 5% bonds. Okay, don't be confused. In the last 2 examination question we have done, the company had issued the bonds. They had given the debentures or bonds. Here, the company has not issued the bonds. They have acquired this. That means what? Is it a financial liability, FL, or is it financial asset, FA? What is it? Is it FL or FA? This particular component. They acquired $9 million 5% bonds. This is what? FL or FA? It's not a financial liability, it's a financial asset. Some other company ka bonds this company has purchased as such. Okay, so this is an investment they have purchased. These are not liability. Okay, watch out for that. Those Josh may don't say compound financial instrument and start off. Okay, so this is a financial asset that they have acquired. So the value of that financial asset is $9 million. They've acquired, purchased a bonds. That bonds gives you an interest rate of 5%. On 1st January is what we have acquired. And the year is ending on 31st December. Okay. The interest is receivable 31st December every year. Awesome. Vernon incurred 0.4 million broker fees when acquiring the bonds. Okay, stop it here only. This is a financial asset. We have learned when we did financial instrument wala topic, we learned financial asset. There are 3 methods under which financial asset could be valued. What is that? One is amortization cost method, ACM method. Another one is a fair value through other comprehensive income, FVT OCI. Or third method is FVTPL, fair value through P&L. Which one you will go for here? ACM, FVT OCI or FVTPL? Which method? Let's jog our memory. This was done maybe about 2-3 weeks only. We did this, no? Yes. Can you tell me which you will value this financial asset using which method? Using ACM, FVT OCI or FVTPL? Using ACM method. Why? Sir, if you want to go for ACM method, there were 2 conditions. One, the business model should be to hold the investment till maturity and collect on the contractual cash flows. And the cash flows that you are getting should meet SPPI test, sole payments of principal and interest we say. If SPPI test is met and if you're planning to hold it till maturity, then we apply ACM method. No, if your intention is to, you're saying, okay, right now I bought this investment. If I get better investment opportunity, then I will sell it off. Then you will go for FVT OCI method. If you cannot go for ACM or FVT OCI method, then you will go for FVTPL method. That also I had given in the charts. I will just show you. Okay, everything we have done here. Yes, financial asset, debt instruments. This is okay. These are the 3 methods. So here looks like they have not told anywhere there the company is saying anything. Check. They have incurred brokerage, which was being expense to operating expense. So brokerage, they've treated that as operating expense and transferred to SPL. These bonds are repayable at premium, so effective interest rate is 8%. Vernon Co, the company, however, has recorded the interest received on 31st December as investment income. Anywhere have they told the company is planning to sell the investment? Anywhere had the company told here they're planning to sell the investment? Or in other way, if you want to go for FVTPL method or FVTOCA method, one simple thing you require or one major component you require. What is that? Fair value. Because method itself is fair value through other comprehensive income. Fair value through P&L. If you want to go for that, you will absolutely require fair value, correct? Year ending of fair value, anywhere have they given here? No. And moreover, they've given effective interest. So which method requires effective interest, guys, among the 3? ACM, FVTOCI or FVTPL? ACM method. That means indirectly they're telling you the company is planning to hold this investment till maturity and so hence go for ACM method. Okay, fair enough. So now we conclude that this is an ACM method. If you're going for ACM method, then this brokerage fees and all is transaction cost. No, if you're following ACM method, what will happen to transaction cost? Transaction cost, will you transfer to SPL? No. Under ACM method and FVT OCI method, any transaction cost like brokerage, any acquisition charges is there. It will be capitalized, meaning it will be added to the cost of the asset. We had written it here if you remember. Transaction cost is capitalized. Remember this? Okay, both under ACM method as well as FVTPL method, FVT OCI method. Only under FVTPL method, transaction cost goes to SPL. Okay, alright. These are the fundas they're testing. But by mistake in this problem, transaction cost of 0.4 million, they've put it off to operating expense. That means operating expense is unnecessarily increased. Okay, we need to reduce that. Meaning we need to add this to your financial asset and put up ACM table. Okay, because that ACM table will give you, or not necessarily you have to put up a table. If you're comfortable, you can do it directly or put up a table and do it. Okay, on that investment, we're going to get interest. Okay, here it is not finance charges. It's an asset. That means it's a finance income. But finance income should be booked again using effective interest rate of 8%. But the company, what have they done? Actual interest they've taken. Check here. These bonds, the company has recorded interest received on 31st December as investment income. How much interest the company is receiving actually? 5%. So only 5% of interest income they have transferred to SPL as investment income. Actually, interest should be booked using 8%. That is another mistake. Okay, they have under recorded the investment income. That requires another adjustment. Okay. So did you get so far whatever we discussed? Theory, concept I was explaining. Numbers we'll have to. If you have understood the concept, it's just application of this in numbers. That's it. Okay, awesome. All right, 1 minute. Where did the question go to? Okay, till here we have done. Fourth adjustment. During the year, Vernon revalued its head office. So on property, plant and equipment, they have revalued for the very first time. So watch out for this. So first time if you're doing any revaluation, and if you get revaluation gain, where it will go to? Revaluation surplus, meaning OCI. If you are doing a first time revaluation, and if you get revaluation loss, where will first time revaluation loss go to? SPL. Yes. So here we need to check. Resulting in increase in value of 12 million. Increase in value means gain or loss? Value is increasing. That means it's a revaluation gain. Where will this revaluation gain of 12 million go to? It will go off to OCI as such. Okay. So that means in this problem, you not only need to prepare SPL, probably you need to prepare other comprehensive income also. So basically total comprehensive income, meaning SPL plus OCI when you prepare one statement. That we call it as total comprehensive income. No, probably that is a requirement here. So revaluation surplus is 12 million. Deferred tax is applicable to this gain for 25%. If you remember deferred tax, okay, how do you get deferred tax, sir? Carrying amount, and in fact, I've given the equation also. If carrying amount is greater than the tax base, then what do you get? If carrying amount of the asset, if it is greater than the tax base, what are you going to get? DTA or DTL? If carrying amount is greater than tax base, you're going to get deferred tax liability. Yes, no. Here you did a revaluation. Due to revaluation, carrying amount of the asset increased. But in tax laws, there is no revaluation and all. That means the tax base is same. That did not increase. That means carrying amount is obviously greater than tax base. Yes. So due to this, you need to create what? There will be some difference between accounting records and tax records. Okay. Again, these are temporary difference only. Okay. Not permanent difference, temporary difference. So you need to create only for that temporary or timing difference. We need to create DTA or DTL. I told you in your syllabus, majority it will be DTL. So here carrying amount of the asset is greater than the tax base. Hence we need to create deferred tax liability of how much? 12 million. Huh? No. 12 million is the difference because carrying amount increased by 12 million. Tax base did not increase because in tax laws there is no revaluation wala funda. It is there only as per IAS 16. Only as per accounting standard revaluation data is there. So carrying amount is greater than tax base by 12 million. That is the difference. Take the difference, multiply by the tax rate. You're going to get deferred tax liability. So 12 million ka 25% will be some number. That is your deferred tax liability. Okay, one question I have for you. You need to create deferred tax liability here. I think that much everybody has got. You'll create this deferred tax liability using SPL or OCI. That much you tell me. Because entry for DTL is very simple. It's a liability. So you will credit liability. So the journal entry is either as SPL account debit to deferred tax liability DTL or OCI account debit to deferred tax liability. Here you'll use SPL or OCI. Perfect. You'll use OCI. Why? You are getting this deferred tax liability only due to revaluation. Due to this revaluation gain. Yes, no? Where will the revaluation gain go to? Revaluation surplus OCI. Meaning using the same revaluation surplus, you need to create deferred tax liability. We have done this again. Same adjustment. So the journal entry will be revaluation surplus OCI account debit to deferred tax liability. So effectively your revaluation gain will reduce because of this. Though you got revaluation gain of 12 million, you need to create DTL out of that. So revaluation surplus will be little lesser than that. That is the adjustment. Okay. If you just go through our iOS 16 notes, you will find a couple of problems with this. Nothing is new according to me so far. Okay. More importantly, what I'm saying is do you agree with my statements? Are you able to remember the problems we have done with all these concepts? If you're frequently revising, you should be. Okay. Otherwise, yeah, you need to increase your revision speed. Alright. Vernon Co. values its investment property. The moment you say investment property, which standard investment property? IAS 40. Okay. IAS 40 deals with investment property. Investment property are valued at fair value. And if there is any fair value gain loss of investment property, where will that go to? For investment property, gain loss will be going off to where? SPL or OCA? On investment property, you show gain loss will be fair value gain loss will transfer to SPL. Perfect. So here investment property increased in value by 4 million. So this is a fair value gain. This fair value gain should be transferred off to SPL. Under which category? Since this is an investment property, you will treat that 4 million or you will put that under investment income. You will add that 4 million to investment income. Again, I think I had called that just to jog our memory. I'll just show you here. Investment property is shown at fair value model, meaning investment property will be shown at fair value at each year end. And if there is any fair value gain or loss, that will be transferred off to SPL as such. And investment property are not depreciated because anyway it is shown at fair value. If you depreciate, its fair value will reduce. That's the reason investment properties are not depreciated as such. Okay. All right. If fair value is, however, you cannot determine for investment property, then you can go for cost model as per IAS 16. That is not relevant here. Leave that. Okay. So here there is a fair value they have given. They valued under fair value only. So this fair value gain will go off to SPL. So we'll add this up. Tax figure in the trial balance. Okay, 1 minute. Let's test how well you understood last problem. In the last problem also it was there. Tax is 130. Okay. Now 130 they have given under debit balance. Now you tell me by looking at this, it is an over provision or under provision. Last problem, same tax was there, but it was having on the credit side. Okay, here it is coming on the debit side. If you just check all these numbers for the debit, all these numbers are for the credit. Okay, now this 130, can you tell me it's over or under provision? Yes, I'm getting a response that it is an under provision. Perfect. Okay, so that means 130, what do I need to do? I need to add back. I told you, if it comes to the credit side, it is over. If it comes to the debit side, under. That's a formula. If you want the logic or the ledger, maybe once again I'll show you when I do this exam. Okay, last problem we worked out with the help of logic as well as the ledger, both I showed. No? Okay, tax figure in trial balance represents under or over provision. You need to figure that out from the previous year. Current tax liability for the year ended is 3.2 million. That means this is the closing balance of provision. Opening balance they've given, closing balance also they've given. Okay, so you need to find out how much is the tax expense you need to create in the current year. So even deferred tax liability will be considered. In the last problem we worked out, even DTL we considered. But here, DTL you're creating out of which? This deferred tax liability is related not to SPL item. It is related to OCI items. Okay, so this will not come in. Okay, this DTL will not come in. Okay, because it is related to OCI. Only this will be considered. Only these two you will consider and find out the tax expense. Fine. So it's basically an under provision. You need to add back 3.2 million. Add that 130. 3.2 million. If you have to express in 1,000, it will be 3,200. So that you add that 130. You're going to get the tax expense for the current year. That's all it is. All right. On 1st January 2008, meaning at the beginning of the year, Vernon had about 30 million equity shares. On 1st April, they issued additional 5 million shares at full market value. Okay. And on 1st July 2008, Vernon performed a 2:5 right shares, meaning for 5 shares, the company has given an option of 2 right shares. If a shareholder has 5 shares, he has a right to buy 2 more right shares at 2.4 per dollar per share. Right share is eligible to buy at 2.4. That is the exercise price of the rights. Where did it go? Here. The market value of the Vernon share was 3.1 per share, meaning the fair value of the shares before the rights issue was 3.1. Whenever there is a rights issue, we need to calculate something known as TERP, you remember? Theoretical X right price per share. Okay, for that they have given this data. So rights issue ka concept they are testing. Again, something which we have done. Alright, so this will impact our EPS wala calculation. Probably they are asking you to calculate EPS also here. And also it will affect your SOCI. Let's see whether they are asking. One, they are asking SPL and other comprehensive income. We got to know. The moment we saw revaluation surplus, I think the indication was clear that they want us to prepare both SPL and OCI for the year ended. Also calculate EPS is what they are saying. Your SPL carries about 15 marks. EPS carries about 5 marks. So totally about 20 marker wala question. Okay. So again, so can we start with this question then? Pretty easy according to me. Alright. I don't see much of a difference there, but nonetheless, again, more than me feeling, it's you who has to get it. Okay. So let me try to copy this time whether it works or not. Before the break it gave a little hiccup. Okay, this time it is allowing me to copy. No, still it is not allowing me to copy. Some internal error it seems. I don't know what is that internal error. Okay, no problem. Then it means I'll just write it. Okay, SPL in the examination, please don't type. You have an option to copy from the question into your spreadsheet. Always use the copy paste option. That will avoid the spelling mistakes and more importantly save the time. These are lengthy questions. It will take some time. So use always the copy paste options, which I'll show you. Alright, but nonetheless, always use that. Here, unfortunately, I don't have that. So SPL and OCI for the year ended. Of which company by the way here? Of Vernon, right? Vernon. Okay, I think let me increase the font size a little bit. I think you're not able to see it, I think. Okay, now I think it should be a little better in terms of viewing. SPL and OCI of Vernon for the year ended. For the year ended, I think it is year ended 31st December 2008 if I'm not mistaken. Yes? Yeah. Alright, so let me have this. If you want, you can have again, all the numbers are in thousand. So let me mention that. So all the numbers are in $1,000. I'll highlight this. Then you can start with the revenue. You can keep the format ready so that it will be easier. Revenue minus cost of sale will give you gross profit. From gross profit, if you deduct operating expense, you're going to get your operating income. from operating income, if you deduct your finance charges and if you consider your investment income, you're going to get your profit before tax. From profit before tax, deduct the tax expense, you're going to get profit for the year, or profit of PAT, profit after tax, profit for the year, I'll write. Okay, this only becomes ish for my your this thing calculation, EPS wala calculation. Okay, so alright, so this I have. So see, they have not asked, so I'll not bother doing that. Second requirement was to prepare EPS, no? So I'll have that EPS requirement here as well. So I'll highlight this. Maybe I'll highlight this. So how do you get EPS? So that we require ish, earnings attributable to equity shareholders. For class purpose only, we're calling it as ish, divided by weighted average number of equity shares, which we're calling it as WANES. So that will give us, so EPS will be, I'll write this as maybe A. I'll call this as maybe B. So your EPS will be, EPS is nothing but A divided by B. A by B will give me my EPS as such. Okay, so I have the format and everything ready here. So now all the working notes is all I required. So I'll do all my workings probably this side. So I'll start it here, workings. You can do it there or you can do it down. You are comfortable. You have an option to scroll it sideways and like horizontally and vertically. Whatever way you're comfortable, you can do it. If you want, I can run it in the vertical format only. No issues. I'm just doing this for the connection. That's it. Okay. Or let's do one thing. Let me copy the numbers first, what they've given in the question, so that I don't have to read the data again. First, revenue they've given is 75350. Okay. Then cost of sale they've given is 46410. Okay. So revenue minus cost of sale will give me my GP. So I will give a formula for this. Okay. So far it is standing. I know this is not my correct revenue because many things they missed out. Operating expense they've given operating expense they've given 20640. Again, I know this is not the right income. I need to do some corrections. I'll do it. Gross profit minus operating expense will give me my operating income. All right. Finance charges, again they've given 4050. Some corrections is required. Even in investment income 1520, that they've given is not right. There is something. So that means operating income, if I deduct finance charges and if I add investment income, I'm going to get profit before tax. Tax expense, I'm going to do it. From profit before tax, if I deduct a tax expense, I'm going to get profit for the year. So I have my links ready. So this profit for the year only becomes my ish. So I'll link this also. Okay. So as and when I update that, this also gets changed. WANES, I'll put up a working note. Okay. So this EPS will be this divided by this. Okay. So right now this number is not there. So it is showing incorrect formula. When we put up the working note, our answer will be automatically popped out. So, okay, first working note number 1. What can we put up as working note number 1 here? Working note number 1 is for your significant finance component. Yes, no? So, we'll write it as SFC or significant finance component. Okay. All right. So, for that first we require what? Whenever there is significant finance component, revenue should be recognized at, or we can write here, revenue to be recognized. Revenue to be recognized at cash price equivalent or CSP, cash selling price we used to call it. Yes. So cash selling price. Okay. So we can give that as CSP in short form. CSP is equal to what? CSP is equal to present value. Present value of cash flow. So if you find out the present value of cash flows, you're going to get CSP. So how much is the cash flow here? They've given 8 million. So CSP is equal to how much then? CSP is equal to how much is the value there? Let me just enhance this. CSP is equal to 8 million you're going to get. So I'll write it here only. 8 million. 8 million is 8,000 multiplied by the discount factor. How much is the discount factor? They've said here cost of capital is 8%. They've given, or we need to compute. They've only given discount factor, which is 0.9259. So 0.9259 into 0.9259 I need to do. Okay. Alright. So this if I do, I'm going to get the present value of cash flows. So I can show this in bracket if you want, just for examiner reference how I have calculated this. I've copied that and I'll paste that here. Okay, it's not coming in. No issues. 8,000 into 0.9259. So revenue should be recognized at 7407. I'll round off this. So 7407. Okay. But how much is the revenue booked? How much is the revenue recognized? Revenue recognized by the company, by the entity, is how much? Or by Vernon only you can write. Revenue recognized by Vernon is, they told company has booked a revenue of 4 million, I think, no? They have recorded 4 million. 4 million, if you have to express in 1000, it will be 1000 again. So again, you can write here, give the heading as all the workings in $1,000 if you want, you can write here only. Workings, all workings in $1,000. All workings in $1,000, like this if you write, so you don't have to write everything one by one. Okay, revenue should be recognized at 7407, but they recognized at 4,000. That means additional revenue, how much we need to recognize? Additional revenue to be recognized. Recognized is 7407 minus 4,000, which is 3407 is additional revenue we need to book. Okay, this is one adjustment. Manageable. Guys, comfortable? So for this, what is the journal entry actually is required for this? If you want the journal entry, I can tell you here. What is the journal entry? This is only for your reference I'm writing. Receivable account debit. Okay, debtors account debit basically. Receivables account debit 7407. To what? To revenue account. Okay, this is the journal entry they should pass. Okay, and receivable is a financial asset. Yes, receivable is a financial asset. Financial asset ka what will you measure it at? Using ACM table. Yes. So you are showing the receivable at 7407, but will you collect 7407 from your debtors? No. How much will you collect? You will collect 8 million. So the difference between this 8,000 and 7407, it's time value money ka interest income that you are receiving, because you will not receive 7407 from your debtors. This is a receipt, not payment. So you will receive more. The difference between that is nothing but finance income. Okay. So that we need to record. Okay. Finance income we need to write. So we can put up ACM table and figure that out, like opening balance, year opening balance, finance income, prepayments, closing balance. Since they did not ask balance sheet, only finance income we require. So hence I can do it directly only here. How do we do it directly? Take this multiplied by the discount factor. How much is the discount factor? 8%. Yes, no? Correct. That will be your discount factor, and you made the sale on 1st July only. Correct. And one moment. In fact, this is important. You made the sale on 1st July, but your year is ending on which date? December. So July, August, September, October, November, December. That means if you multiply 7407 into 8%, 8% is for the whole year, no? Correct? But that means, should I book it for 8 months, or should I do some other adjustment here? One more adjustment I need to do here. What is that? Into 6 by 12 I need to do. Yes, perfect. So I need to do 6 by 12 because transaction happened on July and year is ending on December. So finance income you need to book only for 6 months, from July to December. July, August, September, October, November, December. Okay, so that is it. So this is the finance income we should have booked. 296. So that means finance income, what they've given, investment income, that is not right. So to this I will add 296. Getting it out? This is one adjustment I need to do. I've rounded it off to 296. Fine. Alright, so maybe I'll just increase the space also so that it's visible. Okay, so this is fine. Finance income. So working note number 1 is fully over. I think revenue ka adjust. Okay, revenue also I need to do. Yes, they did not recognize this revenue only. Or no, they recognize how much revenue? 4,000. They had to book 7407. So how much additional revenue I need to book? 3407. That means this I need to add by how much? 3407. All these are my working. Alright. So then I'll just give a formula there and update it. Okay. Alright. So this is my, I think first working note ka full effect is given. Any confusion you guys have in the first working note? No. No. Okay. Then I'll move on to the next second working note then. Second working note is related to your foreign currency customer. So I'll write it as exchange gain or loss. So working note number 2, I'll just give it as exchange gain or loss. I don't know whether it is gain or loss. I'll write both. Exchange gain / loss. That is my second working note. Okay. So first, all foreign currency transactions should be initially recorded at transaction date ka spot rate. This transaction happened on 1st December. That means initially receivable will be shown at what? Or you can write here receivable balance. Receivable balance was on. Or you can give one heading also if you want. all foreign currency transaction. If you have time, write this. I would suggest write it, but in case you have a shortage of time, skip the theory lines. Okay, the concept basically. All foreign currency transaction should be initially recognized. What I've written in the chart, no, same thing you need to write. Should be initially recognized at transaction date, or recognized using transaction date spot rate. You can write using transaction date spot rate. So receivable revenue will be how much? Revenue and receivable. I'll write revenue and receivable, because the journal entry for this is what? Debtors account or revenue account, or debtors account debit to sales, no, or receivable account debit to sale. So initially receivable and revenue will be shown on 1st December, no, on 1st December 20x8. Transaction happened on 1st December 20x8. Yes. So they are saying $1 is equal to, they're saying $1 is equal to how many kryptons? 6.4 kryptons, or which we can call it as KR. I think that's what they're calling it as, no? KR they're calling it. Okay. $1 is equal to 6.4 kryptons. So how many dollars we have made the transaction with? We made the transaction for 12 million kryptons. So if $1 is equal to 6.4 kryptons, 12 million kryptons is equal to how many dollars? That cross multiplication. So how much will you recognize that as? You'll take 12 million. Okay, 12 million is 12,000. 12,000 divided by 6.4. So this, if you want, you can show as a working to the examiner. I'm just expanding the screen there, so I'll just give plus here so that it will be auto calculated. That means the revenue and receivable will be initially recognized at 1875. Okay, then receivable is a monetary item. Monetary item should be shown in balance sheet at what rate? Receivable is a monetary item. Monetary item, and monetary item we will give the reference here as MI, and all MI should be reported in SOFP, statement of financial position, using closing rate. Okay, so closing rate means the rate existing on the balance sheet when you prepare balance sheet. Here you're preparing balance sheet on 31st December. So on 31st December, what is the rate? $1 is equal to 6 kryptons. Same thing. So I'll just write this again. So copy paste this. So $1 is equal to, on 31st December, how many kryptons? $1 is equal to 6 kryptons. Means that 12,000 kryptons is equal to how many dollars? So 12,000 divided by 2, which will be how much? So let me copy paste. That will be 2,000, no? Yes. So I'll just insert is equal to or plus symbol. It will be automatically calculated. So receivable should be shown at $2,000. Okay, but currently you're showing it at $1,875. So the receivable balance. So receivable balance, not revenue. Okay, only receivable this time. Okay, what happened to this? Receivable, revenue will cut off from this. Receivable balance not on 1st December. Receivable balance on 31st December will be 1,200. You are showing the receivable at 1,875. Your receivable has become 2,000. So it's happy face or a sad face for you? Happy face or sad face? Initially you thought you'll receive $1,875 from your debtors. Now it looks like you'll receive $2,000. That means you're receiving more, no? So it's happy face. That means this is an exchange gain or exchange loss. This is an exchange gain scenario. Yeah. So we'll write here exchange gain. One minute. Exchange gain. Exchange gain is equal to 2,000 minus 1,875, which is 125. And this exchange gain will come under where? This exchange come under, like under operating expense, we show this as a deduction. So I'll show this under operating expense. I'll show minus 125. Okay, so this portion is done for. Any doubt, anybody here? First of all, and moreover, one more concept is there here. What is that? This transaction they told, it was not even recorded, they told. Yes. If you just check, has sold the goods, no entries have been made to record this. That means revenue what they've shown is correct or incorrect. They did not pass this entry only. That means the revenue shown is incorrect. How much is the revenue you should recognize for this? 1875. So go to your revenue and write plus 1875. That is another impact this transaction will have. Other impact is receivables, but they're not asking balance sheet, so we can leave that out. So this is our second working note. So I will write this as like an exchange gain. So working note number 2 is also over. I think fairly comfortable with this. So next is working note number 3. What is working note number 3? Working note number 3 is for the financial asset, correct? So I'll give the heading as financial asset bonds. Financial asset hyphen 6% or no 5% bonds. 5% bonds. Okay. So that is the heading. Then you will write these bonds. These bonds are measured using which method? Are measured using amortized cost method. Yes. Are measured using amortization cost method or amortization cost model. Okay. I'll write amortization cost method as ACM. And as per ACM, any transaction cost incurred to buy or incurred on financial asset, what should you do for the transaction cost? Should be capitalized. Yes, should be added. That's what is capitalized. Should be added to the cost of financial asset. Okay, so this is the remark I will give it to the examiner. Okay, then I will write financial asset FA hyphen 6% bonds. 6% bonds. Balance on which date? Initially you bought this bonds on which date? You bought it on 1st January. So I'll write it as the initial balance on 1st Jan 20x8. How much? Though you bought it for $9 million, you incurred a transaction cost of 0.4 million. That means the transaction cost will not go to SPL. It will be transferred off to, it will be transferred off where? It will be transferred off, meaning it will be added to the cost of the asset. So that means financial cost will be 9 million is 9,000 plus 0.4 million, which is 400. Okay. So this will be your, like, the cost of the financial asset initially. So that is what I'm showing it to the examiner, how I got this. Alright, what happened? I have to remove is equal to symbol. Okay, 9,000 plus 400, that's what I've done. Alright, subsequently you should value this using ACM table. So we'll put up ACM table here if you want. ACM table. Is it absolutely necessary, or we can do shortcut method also? It's not absolutely necessary. We can use shortcut method also. So, but just for maybe it's been 1 or 2 problems, so I'll just put it up for you. Here, then we start with opening balance. Then it will be what? After opening balance, it is finance charges or finance income. Finance income at what? At effective interest rate. 6% is the actual interest rate. How much is the effective interest rate they've given in the question? In the question they told effective interest rate is 8%. So finance income should be booked at 8% interest rate. Okay. Any repayments is there? Here it is not repayments. Here it is receipts. Correct? No, because it's not financial liability. This is a financial asset. On financial asset, you're going to receive. So receipt. So receipt is and then it will be closing balance. Okay. So how much in year is ending on 31st December for us, no? So I'll write it as 31st December 20x8. Okay. So what is the opening balance of that financial asset? That is nothing but 9,400. Here I've got it. Okay. So finance income will be 8% of this. So 9,400 into 8%. That is nothing but your finance income. You could have got it as one liner. Receipt, how much you're getting? This is a, like, this is a 9% bonds. Correct? Or rather, this is a 5% bond and the face value of this bond is 9,000. No. On 9,000, the company will pay interest of 5%. Yes. So 9 million is the bond value. You bought it by paying broker fees. So company, you purchase some other company ka bond. So that company will pay interest. They will always calculate interest on the face value. What is the face value of the bond? 9 million. And the interest on this bond is 5%. So they will pay interest of 9 million ka 5%. That is what I've calculated here. 9 million ka 5%, which is 450. So closing balance will be this opening balance plus finance income minus receipts. Okay, so 9702. This is required mostly for your balance sheet. Okay, where will this finance cost go to? Finance income will go, where will this go to? This will go to SPL. But what did the company do here? Check. The company, what did they do here? In fact, the bonds are repayable on premium at effective interest rate. Verman has recorded interest received on 31st December as investment income. How much interest income did you actually receive? 450. Okay, that they have treated as investment income. What should be the actual investment income? 752. But they have booked only 450. That means how much is additional finance income to be booked? Additional finance income to be booked is how much? They have booked 450, but actual requirement is 752. So 752 minus 450 I'll do. 302 is additionally you need to book. Okay. So this is what I required as such. Alright. So this additional finance income, that means the finance income given in the question is incorrect. So I need to add this by 302, right? The number I got it as 302. Okay, let me go to finance income and add 302. So under investment income, I will add 302. That is the implication of this. Rest everything is fine. And in fact, one more adjustment is there. What is one more adjustment? This brokerage of 0.4 million or 400. What did they do? This brokerage they have transferred off to operating expense. Should we transfer this brokerage to operating expense or it should be capitalized? It should be capitalized. But by mistake they have transferred it to operating expense. That means operating expense unnecessarily has been increased. So operating expense we need to reduce by 400 because that should be added. That 400 should be added to the cost of financial asset. So operating expense I will come. Under operating expense I will write minus 400. That is for that, the brokerage fees. So I think this completes this adjustment. I'll go for the next one. The revaluation. So Varnan is doing a revaluation. So when they do revaluation, what are you going to get, guys? In fact, I should have stopped here. I should have had a couple of more rows on. Here I should not start EPS. I should have a few more rows. Why? Because we have here what? We not only have profit for the year, we also have other comprehensive income here, no? Yes, OCI. Other comprehensive income. Okay, so I'll give that, I'll make that in bold. Yes, so that means here you're getting revaluation surplus. Revaluation surplus. So I'll give revaluation surplus. Maybe I'll do a small working note for this as well. Control C, then I'll maybe make that as next working note. So working note number 4 is my revaluation surplus. Okay, you did a revaluation of property. How much did you get as revaluation, guys? There was an increase of 12 million. So revaluation surplus will be 1 minute. Some serious problem with this laptop, I tell you. It is acting like it has gone cuckoo. Okay, how much is the revaluation surplus you're going to get? Since there was a revaluation gain, you would have got a revaluation surplus of 12 million or 12,000. Okay, that's all, or one more adjustment is there? One more adjustment is there. Since there was a revaluation surplus, carrying amount of the asset increased, but tax base is still the same. So carrying amount will be greater than tax base. Okay, so you can write here, since carrying amount, or you can do here one more thing. I'll write it here and then I'll do that working. Since carrying amount is greater than tax base due to revaluation or due to revaluation gain, comma, deferred tax liability should be created. Okay, out of what? Deferred tax liability should be created, not using SPL, out of revaluation surplus. Out of revaluation surplus. Okay, that is the heading I'm just giving to the examiner here. Okay, now I'll just show this working again. Revaluation surplus, though you got revaluation gain of 12,000, how much a DTL you need to create? DTL will be on this 12,000, you need to create a DTL of how much? 25%. So means the DTL, how much you need to create? 12,000 got 25%. If you calculate, that will be 3,000. So effectively, what is the balance in revaluation surplus? The balance in revaluation surplus will only be revaluation surplus balance. So 12,000 minus 3,000, which is only 9,000. So this is what I need to show in my OCI. If you want, I can show both. Since I've done a working note, I'll only show this number in my OCI as such. Comfortable? So revaluation surplus, I'm going to link it off, or I'll write it off directly here, 9,000. Easy, everybody? This comes under other comprehensive income. So profit for the year and other comprehensive income, if you add, you're going to get total comprehensive income. So maybe I'll just copy from here anyway, most of the words are same. Instead of other comprehensive income, I'll make this as total comprehensive income. So how do you get total comprehensive income? Take P&L for the year, profit for the year, add revaluation surplus, meaning other comprehensive income, you're going to get it. Since I've not got profit figure, since the numbers are not updated. So this is my working note with respect to this. Any confusion here, anybody on the revaluation front? All good? Okay, that means I'll move on to the next one. Vernon also values its investment property using fair value model. Investment property is increased in value by 4 million. That means again fair value gain you've got, but this time on investment property. So investment property ka fair value gain loss will go off to SPL. So under investment income, so you need to add, because it's a revaluation gain. Under investment income, how much is the gain you got? 4 million. So if you have to express that in 1,000, it will be 4,000. So I've added 4,000 here as to the investment income. That is its implication. Okay. Other implication is in balance sheet. We are not preparing balance sheet, so it's okay. Tax figure in trial balance represents over or under provision. Current tax liability is estimated to be 3.2 million. Okay, like last problem, if you want, I can just, if you remember, this is the last problem we did. Okay, so if I copied the ledger, I'll copy the provision, same provision called ledger if you want, and present it like that also. Okay, again only for your reference. Provision. Okay, maybe I'll do a thing. I'll just bring it even further down. Here. Okay. So provision ka opening balance they've given in the question. Check opening balance of provision is coming on which side in the question. Tax is having a balance of 130 on the debit side. No. So that means here I'll write 2 balance brought down. 2 balance brought down. How much? There's not actually opening balance, but after paying the tax, what remains? After they have adjusted opening balance with the tax paid, and they've got the balancing figure as such. So that's why I'm saying it is whatever balance they've given, we'll take it as 2 balance brought down. How much is the 2 balance brought down number they've given in the question? They've given 130. Closing balance, this is not buy balance brought down, so we'll leave this. Okay. So how much is the closing balance required in the question they're saying? Closing balance, how much is the estimate of tax they're making? They are estimating the tax the year end to be 3.2 million. 3.2 million is 3,200. So closing balance is this much. What is the total of this side then? 330 plus, if you put up the sum. Okay. Total is 3300. So that means same thing should come here also. Correct. Same 3330 should be here. Okay. But how much? Anything is there on that side number? Huh? Nothing is there. That means we need to make a provision to this extent in this current year. So what is the formula? So there's nothing but this 130 is nothing but under provision. Or if you want it other way around. Okay. 3,200 is the provision required. Provision of credit balance of provision required. Right now they have a debit balance of 130. That means how much provision you need to make? You need to have a closing balance of provision. Credit balance to be 3,200. Right now they have a debit balance of 130. That means from debit balance of 130, you should go to credit balance of 3,200. That means what do you need to do? You need to make a provision of 3,330. That is another way of, you can do it using ledger or by plain reading or by looking at it also. Okay. So basically debit balance of tax is nothing but under provision which you need to add. If you want, you can take it that way also and do it. Okay. That is what I'm about to write here. So working note number 5 is a tax expense. First, more importantly, did you guys understand at least one of the explanation? I tried to give it in 3 ways. At least one thing went up. Or everything went up. Awesome. Okay. So how do you get tax expense? Tax expense is current tax plus deferred tax. Here there is no deferred tax, meaning no deferred tax related to P&L items. We had deferred tax related to OCI, which we already accounted. So we take provision. In fact, we can copy from the last table only. Here. Anyway, I've done here. So closing balance of provision they have given. Okay. So I'll just copy this only so that I can write the same thing. Only numbers I will modify. Okay, so this is not there. So let me delete this off. Okay, how much is the closing balance of provision required? They're saying closing balance of, in fact, here this is this is also 130 only, like last problem. But here this is over provision or under provision. This case it is an under provision, so we need to add back. So I'll write here under provision, and I'll write the positive number. That's it. I'll write plus 130. That's it. So closing balance of provision they've given. How much they said? Closing balance of provision required is 3.2 million, which is 3,200. That means the tax expense for the current year is 3330. Done. Okay, so that means this also I can go ahead and update that. Tax expense 3330. So you got your tax expense also. Okay, anything else is required? Rest everything is our EPS wala calculation. EPS we will put it on hold. First we'll complete the P&L. So all these are my working. So I'll do a thing. All these numbers I will quickly copy to the other side also. Cost of sales there is no adjustment. No? So wherever there is a working, I'll also show to the examiner. So I will write this. So what else is required? Operating expense there is a working. So I'll copy this. Investment income has a working. So I'll copy this. I think that's about it. No. Yeah. Now I'll just go on. Just press equals to button. Automatically the calculation will come on your screen as such. So I'll just press equals to button. Number I've got it. Here also I'll just press equals to or plus button. So I have this. Investment income is this much. So that means I have PBT. So profit for the year I've got it. So total comprehensive income also I've got it. So this is my final answer. Okay. Alright. So these are the things they asked for, which I've done. So EPS ka each also I've got it. And for each don't take TCI. Yeah? Correct. EPS and all is calculated using the profit SPL data only, not using your other comprehensive income. So take the 12,485 only as such. Alright. So only thing now if I do is Wayne's wala calculation. Or before that, let's maybe cross check the numbers, whether our numbers is right up. So 21,845 is the TCI which we got. Profit for the year is 12,485. So all the numbers are tallying up. If you want, we can just check the other things also. How much is the, GP is 34,222. Yes. Operating income is 14,107. Yes. And PBT is 16,175. Yes. All the numbers seems to be matching with the solution as well. Okay. Not that needs the requirement to be checked, but just giving it for your reference. That's it. Alright, one last working note here is required, that is EPS. EPS ka I require Wayne's wala calculation. Okay. But there are some, the company has given some rights issue here. So that means there will be some problems. For the rights issue, first we need to compute what? For the rights issue, first we require theoretical X right price. Yes, no? So first let's calculate that. Theoretical X right price per share, or we can call it as TERP for our class purpose. Okay, how do you get TERP? So it's basically average price per share. Now let's read that adjustment once more to understand it a little better. Now this company, they are coming with rights issue. In what ratio? If you have 5 shares, if the guys, right shares is given to existing shareholders, new shareholders won't get this. If shareholders already own 5 shares, then they have an option to buy additional 2 shares. But right shares generally will be given at discount. Now check, the market value of the share is 3.10. But these shares are offered to the shareholders at 2.40 at a discount there. Okay, that's what is right shares for you. So you need to compute the right shares. Alright, how do you calculate that? First calculate. We have already done I think 4 or 5 problems relating to this. Yes. First take, how much is the cost of the original shares? Basically you need to find out the average shares. What do we need to do? There is a formula. That formula, if you remember, what is that? Value of the shares before the rights issue plus value of the right shares divided by number of shares before the rights issue plus number of right shares. Yes, that's all. I'd explain using simple logic also how the formula also works, right? So 5 shares you have. What is the value of the 5 shares before the rights issue? 3.10. So I'll write that, or maybe I'll keep the column. 5 is the number of shares, or maybe I'll have the columns as well. So this is the number of shares. This is the number. This is the value price per share. And next one is value. I'll just bring this off. All this you can use it's there in your exams also. Alignment and all. Okay. You have 5 shares. Only right shares works with that only. I told you can compute with individual data or with total data. Either way his answer will get. I had shown you in the examination. When we did that chapter. Okay. I had shown you individually also, cumulatively also. Here individually is easier, so I'm going to work with this. So 5 shares only if you have. If you have 5 shares, then only you will get right shares. Yes, no. So what is the value of the shares before the rights issue? Value of one share is 3.1. That means what will be the value of 5 shares? 5 into 3.1. This is the cost. Okay. If you have 5 shares, how many right shares can you get? You are eligible to buy 2 right shares. At what price? 3.1? No. You are eligible to buy right shares at 2.4. That means what is the value of the right shares the company is going to get? On 1 share, they will get 2.4. On 2 shares, how much it will be? So I'll copy the same formula. Okay. So that means this will be the total cost. No. Correct? So I'll give up a sum formula. So the total cost will be how much? 20.3. Similarly, same thing I'm going to do it here. 7. So 20.3 is the total cost. Yes. If the original shareholder, if he has 5 shares, then only he can buy original share. You can get 2 right shares. What is the value of the original shares? 15.5. Right shares, he has to buy it at 4.8. That means what is the total cost for him? 20.3. 20.3 is a cost for 7 shares. How much is the cost on 1 share? So that is your TERP. So TERP is nothing but here. It is nothing but 20.3 average cost. 20.3 is a cost on 7 shares. On 1 shares, how much is the cost? Which is 2.9. Alright, that is your first working note. TERP wala. Okay, next we require what? I had told you, given an example. I had given a short example and I told you. Right shares also has what element? Right shares also has an element of bonus. Hence, we need to find out a bonus fraction here. And how do you get bonus fraction? Bonus fraction is given by value of the shares before rights issue. Correct? Value of the shares before rights, RIGHTS, divided by TERP, theoretical X right price. Yes, I told you this bonus fraction should be greater than 1. So always you should take the numerator should be greater than denominator. Yes. So what is the value of the shares before the rights issue? 3.1. What is the TERP? 2.9. Either you can have the same fraction or you can divide it and get it also. Since I've written the bonus fraction, I will not solve this. I will not take in the whole number. I will maintain the same fraction. Okay. So since right shares has bonus element, no, so you need to consider that for your Wayne's calculation as such. We have done such questions. How do you get Wayne's? Now go back to the question. So on 1st January, how many shares did the company have? They had 30 million shares. So that means I'll do it in one go. Just see if you are understanding it. 30 million is nothing but 30,000. Correct? No? 30,000. Yes. Okay. Or if you want, you can calculate in full numbers also. 1 million is 10 lakhs. So 30 million will be 3 crores. 3 crores. Yeah, I think that number is right. This much numbers. 30 million is that much. Okay. So you had 30 million on which date? 1st January. On 1st April, you issued 5 million more shares. Okay. That means what? From January till January, February, March. For the first 3 months, can I say company had 30 million shares or 3 crore shares? Would I be right? After that, number changed. That means for how many months? Into 3 by 12, can I say? After that, it changed. Okay, that's all. No. Whenever right shares on this shares only, on these shares, right shares are eligible. Yes, no. That means these shares have bonus element. Hence, what do we need to do? I need to multiply bonus fraction also. So how much is the bonus fraction? Into 3.1 divided by 2.9. Did you get this? Into 3.9 divided by 2.9. So I have to multiply. I had in fact written in the charts also if I had shown you. If you remember this, or maybe in the chart books to retrace your memory. I think I can show. I don't know whether I have the reference of that here. Bonus shares. Right? Even bonus shares also, theoretical X right price ka formula here. This is a bonus fraction. Bonus fraction should be greater than 1. Multiply bonus fraction to the existing shares before the rights issue and existing shares of last year to get Wayne's for the current year and last year. In our question, last year Wayne's also we calculated. Okay. But here they're not asking last year data. They're only asking current year data. So how many shares were there before the rights issue? One, we had 30 million shares. After that, you issued 5 million shares. So 2 shares are there. On both, you need to multiply bonus shares because both of those shares have a bonus element. Correct? Because right shares includes bonus element. I've explained all this to you now. Yes. So this is on the first number. First number, is it looking clear to you now? Or any confusion or repetition? Same thing I have to do it for the other ones also. You guys get this? Got it. Okay. So 30 million shares you had it before. Okay. From January up till 1st April. That is why January, February, March. There afterwards you issued 5 million shares. 5 million is 50 lakhs. So April, May. There afterwards 1st July, May you came with rights issue. That means April, May, June, July. Initially you had 3 crore shares. Then you issued 50 lakh more shares. That means your number will be how much? 3 crore 50 lakhs. Yes, no? 3 crore 50 lakh, then a share will increase. Into what? How many shares? I mean into how many months? Next, right shares came in July. That means April, May, June you had. For the next 3 months, you had 3.5 crore shares. Can I say so? Yes. Or 35 million shares. In India, we use crores. So, yeah. I think in other European countries, we use millions. Yes. So, 35 million or 3 crores or 3.5 crores. Yes. That's all or one more. These were also existing shares before rights issue. That means on this also, I need to multiply my bonus fraction. How much is my bonus fraction? 3.1 into 2.9. All right. This is that. Afterwards, or any doubt in this confusion? I mean, any problems in this working? Anybody? Or all good? Got it. Okay. Next, after this, the company came with rights issue. That means how many rights shares you have. If you want, maybe you can calculate here also. Number of rights shares for your reference. Number of rights shares. Or here only you can put it. Okay. Rights shares is given in what proportion, guys? If you have 5 shares, you're going to get 2 shares as rights. Yes, no? That is what they're saying. If you have 5 shares, okay, I'll just make this as normal, general. If you have 5 shares, you're going to get 2 rights shares. How many shares does the company have before the rights issue? They have 35 million shares. That means 3.5 crores. Yes, no? If you have 3.5 crore shares, how many rights shares will you get? Calculating X method. So that means how much will be the number of right shares? If I have to calculate that in the formula, how much will be that? Is equal to what? This multiplied by 2 divided by 5. Is my calculation right? So company has given about 14 lakh right shares or 1.4 million right shares. Yes. So if the company issues right shares, will the number of shares be same? The company before the rights issue, they had 35 million shares. They issued a right shares of 1.4 million. That means after rights issue, how much will be the number of shares? Will it be same? No, it will increase. How much it will increase by? If you want, we can just bring this numbers down and call that. Bring it down here. Number of shares after rights issue, can you tell me? Total number of shares after rights issue. Number of shares after rights shares. After rights issue. Company had 3 or 35 million shares. They issued a right shares of this much. That means after the rights issue, they will have about 49 million shares. Agreed? Or 4.9 crores. Numbers are right? Looking good? Correct, no? 35 million, 7 million, 14 million. Yes, 14 million it is actually. Yes. So 1.4 crores. That means the number of shares will increase by how much? 4 crore 90 lakhs. Okay, this many shares they will have after the rights issue. Thereafterwards, anything happened? No. That means from what? From the date of bonus issue. That is from 1st July till the end of the year. Number of shares did not increase. It is the same. That means how many months? July, August, September, October, November, December. For 6 months. That means I need to write into 6 by 12. Yes, no? So, or actually, went off. Okay, 4, 1, 2, 3, 4, 6 zeros. Correct, I've calculated. Yes. Into 6 by 12. Why is it going off? It's going off. Okay. Oh, it was not actually going. It was just only hiding. Okay, this is your veins. Understood this calculation, everybody? I'll just show this calculation for the examiner here. Did you guys get that? That is my veins. So veins is given by that formula there. Same thing we have done, just it is taking a little extra time, that's all. Because we have to do it in Excel, no? Alright, this is my calculation. Maybe I'll do a thing, I'll put in brackets at necessary places just to be sure that it is taking the right values. I think it should be okay. It must be calculating it fine only. Leave it's okay. Let's see. Okay, this many shares I'm getting. Okay, this is my veins. So I'll update this veins. Okay. So this, since this number was in full value, no? So I'll kind of, what do I do? I'll just copy paste that value there. Veins is this much. I'll just copy paste the value. Okay. So I'll round it off. I'll maybe make it as 90. Okay. Last 3 digits. Since this number I've taken full. Profit for the year also I'll take it in full only. So I'll write this into 1000. I'll multiply. So I'll get full number. Okay. So profit is that much. Alright. And veins is this much. So my EPS is $0.30. Have they also got the same? $0.30 is what I am getting. Let's cross check once. Okay, 0.30, same check. Earnings is 12 lakh 85. This one is 41870,689. That is what. If you want, you can just put in a comma also, so that easy to compare. All right, that is it, guys. The right shares. Okay, this that asked with that. I mean, anything you want me to go over with you once again, or all good? This is the EPS, another requirement they asked. I don't think it's really that much of a problem. In fact, we have solved a little better problems only in our classes. Yes, no? Yes, we have solved right shares, bonus shares, everything combined. Okay. So here only one things are coming in. If you just check, like, nothing new as such. Everything is just repetition of what we have done in the class as such. Okay. Others also. Any confusion? I'll give you 2 minutes. If that is the case, I mean, we are done with the class here. Others are also having no issues. All right. Awesome then. So that means this question is also done for. Okay. And these are some questions to give you some practice on how examination they could ask you the questions. All right. So hope the session was helpful to you. Thank you.